The Federal Reserve is cutting interest rates for the first time in 4 years. But how long will it take for these rate cuts to have an effect on the economy? There's a phrase economists use so often, it has become something of a cliche.
We all know monetary policy works with long and variable lags.
Long and variable lags?
Policy works with long and variable lags.
It's a quote from the Nobel Prize-winning economist Milton Friedman. He believed that it takes a long time for monetary policy to have its full effect, and that how long can vary from episode to episode. But is this still true? Perhaps not. For one thing, the Fed communicates a lot more than it used to. In the distant past, it didn't even announce that it was changing interest rates. Since 2011, however, it's held regular press conferences and signaled where it thinks interest rates are going to go. This means potentially interest rate changes can be priced in by financial markets earlier than they used to be, and long in advance of policy actually being changed. Take a look at this chart. You can see that in 2022, the 5-year government bond yield, which moves with expectations of interest rates, peaks well before the Fed has finished raising its policy rates. In 2024, it fell significantly, even as the policy rate stayed flat, because it was clear that rate cuts were coming. If anticipated Fed policy is getting priced in before it happens, then companies and households feel the effect on their borrowing costs sooner. Or do they? Let's take a look at historical data around corporate interest rates. This chart plots the change in the Fed rate during times of monetary tightening, and the change in net interest American companies actually paid during the same time period. In the past, the more the Fed rate went up, the more companies' interest bills rose, as you'd expect. But in the monetary tightening from 2021 to 2023, they actually paid significantly less. This is because many companies managed to fix their interest rates in 2020, when borrowing was very cheap. Many are still paying those low rates today. That means that when those fixed rate terms end and companies change to the new rate, they could actually end up paying more, even as the Fed is cutting its policy rate. The full effect of monetary policy changes may only be seen in the economy long after they happen, an example of Friedman's lag. You can make a similar argument for household debt. Take British mortgages. Around 85% of homeowners with mortgages in Britain have a fixed interest rate, meaning that when rates rise, most people's mortgages do not immediately go up. Something similar is true in America. By contrast, in Norway, that number is only around 10%. In theory then, Norwegians should have been pummeled by the increase in interest rates in recent years. On this chart of the exposure of households to interest rate changes, Britain and Norway are horizontally far apart. But this chart also shows on the vertical scale trends in household consumption as interest rates have risen. And the puzzling thing is that Norway and Britain are at about the same height. This means that despite the exposure of Norwegian households to high rates, household spending trends have been similar in the two countries. This is a little baffling. It suggests how monetary policy works might not be affected much by fixed mortgage interest rates. Perhaps Friedman's long and variable lags are getting shorter, but it's tricky to say exactly when interest rate changes have their full effect on the economy. Ultimately, economists know that monetary policy works, but saying exactly how it works is much harder.